Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 20th, 2019. Doing this video mostly for the YouTubers. The last few videos I've done, several have been for members only because I wanted to cover. There haven't been a lot of new developments in the broad market. We just grind up we've had some price compression, and as such, I've kind of packed in other trade updates, commodities, gold, GDX, treasury bonds, crude oil, natural gas, you name it, into the videos, and that's all. Most of that's public, or I'm sorry, premium content. On that note, by the way, I get a lot of requests. The last week, the other thing I've been working diligently with so a couple of programmers on upgrading the site. We're doing a complete overhaul, a lot of the software that runs the site, building out our support page, updating the membership software, and we do expect to open up registration very soon. If you're on the email list, I know I haven't said anything out because we just haven't had anything firm yet, but we're looking now, hopefully within the next week, no more than 2 weeks out, to be able to open up registration, and I will follow up with an email to those of you on the list for the waiting list. I'll follow up with details. All right, let's dive into the charts. Again, not a whole lot to report in the last week or so, and usually I don't do video updates if there's nothing new to report, but I do want to make mention of a couple things. Just to recap, this is the QQQ daily chart, strong rally. We all know what's going on. And what I've done in the last about the last week or so is I've modified a trend line that I'm focused on a little bit more than the one off the lows. I think a lot of eyes are on that trend line, but I do have one here. You can see it doesn't show well here on the daily chart, but on the futures we'll get to in a second. There's a reaction low on the 27th that comes into play, and I believe that might be it right there. No, it's back here. But either way, that's a trend line I'm watching. And if you recall in a recent video, I talked about the although we don't have divergence, and divergence is not a be-all end-all, and it is, they do work out once they're confirmed, and that's what I always say. They're not sell signals or buy signals, bullish or bearish divergence, merely an indication of a likely trend change, and that's what we had at the last high. And the last time we had divergence, we had it on the RSI down at the lows here, and QQQ and everything else. But what we do have, the other takeaway from using the momentum indicators is really the posture of the lines. You have the PPO line, which is my preferred indicator. It's very similar to the MACD. If you don't have a PPO, use a MACD, a close cousin. And then the signal line, which is a white line. And so when you get clean separation, that means you're in a trend. And that the histogram will help show you that. And what I'm getting at here is any type of moving average, or the momentum indicators, which are simply using a moving average. That's what your signal line is, a 9 EMA plotted over the PPO line. So what happens is when you're in a trending, not a trending market, a choppy sideways market, we really don't have much of that here, a little bit back here where we're sideways. Trend indicators and signals off the momentum indicators like the MACD and PPO don't work well. You get whipsaw signals, up, down, up, down. But when you start to get these clear trends, and the way other than visually looking at prices and identifying those trends, you can see it on the MACD. You get what I call these hills. The MACD, I'm sorry, the histogram. You could use a MACD or a PPO histogram. And so you get these big, clean hills, not these little whippy things here, which come in a sideways market. And and basically they're going to tell you when the PPO makes a bullish or bearish cross, when it crosses above or below its signal line. And they do pretty good jobs of giving you buy and sell signals, or at least confirming. I like to always use either a chart pattern breakout, a break of trend line support, price resistance, trend line resistance, things like that is the entry trigger, or sometimes it'll be a bearish or bullish candlestick reversal pattern. But you can see when you have these clear, clean, well-defined hills, if you call them, they help to capture the bulk of the trend and tell you what's coming up. And also, and I covered this in a recent video, is you can see when you start to rally starts to lose momentum, you can draw divergence off those lower and lower peaks. And even again, you can capture the little corrections in there with these crossovers. So you want to watch these hills, if you call it, on the histogram for zero line crosses. Looked like we were going to get one there, but we didn't. Looked like we were going to get one there, and we sure did, and it came right at about right here. So it caught that correction. There's another one, caught that correction. Um, and remember, we're starting to wedge up, and that's where it gets a little tricky because it's price. You get that price compression within a wedge type pattern. The hills become smaller, and so at that point, you want to kind of move back to look at the bigger picture. For example, there was this longer term trend line that broke and gave us a sell signal. So where am I going with that? Fast forward to today, we have a ginormous, we'll call this a mountain. This is we'll call this Mount Everest, if you will, for as far as histograms go. On the PPO, you usually don't see one get this high, meaning that the PPO lines had a lot of clear, clean separation. And as you can see, and this is as we get into the 60-minute charts, I'll show you, and we all know, well, maybe we all don't know, but momentum has clearly been waning. In other words, and I've said this many times, the bulk of the gains from this rally happened off the lows. And I have no doubt that left the majority of the investing public behind who are now chasing those gains. This is where the easy money was to be made. This is where we were long, and I was long personally and bullish on the site. This is where I started taking money out of 401ks, everything else that I scaled to down here. And although I've missed out on these gains, it wasn't, again, it was a fraction of what we saw in the first 3 weeks of this rally. I'm going to get to that in a second, show you the statistics on that. The numbers are pretty clear. Now, before we do that, as you can see, this hill, you can see the peaks are lower and lower, and we're poised to make a bearish cross. And so while nothing is guaranteed, I really, one of the nicer sell signals are pretty clean, pretty reliable when you have what I call a high level bullish, it would be a high level bearish PPO crossover. Or, sometimes you get a low level bullish PPO crossover. And what you need to see is a clean separation like you had here, and then a bearish cross at high levels. We had one right here. You can see the separation. The histogram tells you the clean separation. You can see one here. And again, that marked these corrections. So that's what these things are all about. They're PPO and the MACD, they're momentum indicators, and they just tell us that this rally is losing momentum. Now, there are no guarantees. It doesn't mean that it won't take a breather like it did back here. It was losing momentum at that point and decided to take another thrust up. Maybe that's the case, maybe not. I think at this point, even the most bullish bull is, I think most people on the same page that, look, we're going to get a correction soon. And I think where the crowd differs is, will that be a buying up on the road to new highs, or will it be the net first leg down of much more to come? And that's the million-dollar question. So let's get to the charts and we'll take a look at some things. Okay, before we dig into the shorter-term charts, 60-minute charts, because I do want to point some things out there that I'm watching. Here's a post I put up yesterday. This is public content. It was on the right side of the chart. Hail, 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 the bear is dead. Let's see, or is it? And so basically what prompted that is Friday I noticed in the headlines, I get an email on the articles in the journal, and the journal declared, here, let's zoom in a little bit here, Nasdaq exits bear market as stocks rally. The tech-heavy index closed more than 20% above its Christmas Eve low, entering a new bull market run. So according to the journal, we're in a new bull market. Is that the case? Well, maybe. Time will tell. Let's zoom back into this chart. So what I did, of course, they're quoting the Nasdaq. So I pulled the long-term chart. This is 20-plus year chart of the Nasdaq. And plain and simply, you can see we've had over that time period so far two definitive bull markets, bear markets, I should say. And this one, there are a lot of pundits out there that consider this a bear market. I personally think, and again, it's written, my thoughts are in this article if you want to visit the site's open content, that I think people put too much into, those old, hard and tried true numbers that a correction is 10% or more, a bull or bear market is 20% or more. Everything should be taken relative to the scope of the pattern. In other words, when you have, let's just say you're trading a chart pattern and it's, relatively small move and you're looking at a bullish falling wedge. You measure the widest part of the wedge and your measured target would be the breakout. You add the widest part of the wedge to the breakout point and there's your target. So the bigger the wedge, if it's a multi-year wedge, the bigger the target. And that typically holds true So when you look at, of course, this bull market, which is the second most powerful in history, almost the second longest. This one tapers off. This one started back in around 90. So this is still, to this point, the longest bull market in history. This one's right up there. And so when you look at the scope of the pattern, this is technically just a correction within a bull market. All right, I don't want to spend too much time on that. However, back in 2015, the small caps, mid caps, majority of sectors all exceeded a 20% drop. The Nasdaq missed it by the skin of its teeth. So, as Warren Buffett once said, if it's not a bear market, then what is it? Referring to it. We also had 2 years of sideways trading, where the market was, at this point right here where it was 2 years earlier, or almost 2 years. So now, with that being said, I just wanted to talk about that 20% number. So again, I took this, did these stats, was it yesterday? Either yesterday or the day before after the close. So you can see we've rallied roughly, this is a measuring tool, about, a little shy of 22%. Yeah, by the definition of a 20% rally, it's a bull market. However, let's take a look back here, 2000 market top, which is really, as far as the scope of a bull market, this one can only be compared to this one right here. And so back then we had the top, and we had a 41.3, we'll call it 41% rally. And I'm referring to the initial kickback rallies. That's what I'm looking at here. Every bear market and bull market, they go in cycles. So you have these waves. This was the first wave down. This was the initial bear market rally. There's your big, powerful wave 3 or whatever it is if you're an Elliott waver. And so you can see 41%. Back in 2007, we went up 19%, so we missed that designation by 20. So if we had ticked up just 1% more that day, they would have called that a bull market, but would it have mattered? No, because there still was another 51% downside to come from the peak there. It's all measured from that peak. We dropped another 51%. From this peak on the bear market rally that was 41%, we dropped another 74 before all was said and done. And even back here in 2015, we had the initial leg down. We had divergence, a lot of things pointing out and indicating that was coming. We had a round up to 21% snapback rally, the initial snapback rally. And although this didn't prove to be a traditional bear market that lasted for, more than a year or so, there was another leg down again. And you can see we almost came up to the previous highs. So we retraced well over, almost 100% of the rally. It was about 21%. And then another sharp, wave down that was just as sharp as the previous wave that undercut those lows. At that point, we put in a divergent low. It was another 19% drop. Point being, a lot of people thought it was safe to get back into the water right there. So time will tell. Look, I'm making a case, obviously, that's showing you that this may or may not be a bear market rally, but the fact that we're up 20% and what you're reading, again, this is nothing out of the ordinary. What wasn't expected based on what we fell down. Everything that was talked about. We're going to get a sharp snapback rally at some point. And the fact that we had a very sharp sell-off on the initial leg down led to a very sharp snapback rally. In 2007, it was a little more controlled descent, so it wasn't really, we didn't get that V bottom. But back in 2000, we had that very sharp sell-off, and that's why we had a very sharp snapback rally. So that's what's going on here. I talked about that too, and I think that plays into the strong breadth numbers that we've seen lately in the advanced decline line. Oh, and I have a chart to show you on that too. Let me find that. Okay, here's a post in the trading room the other day. A member posted, another commentator talked about how bullish it is that we made an all-time high on the NYAD. That's the percent of stocks in the NYSE. Advancers versus decliners, not the percentage, the advancers versus decliners. So in that post, which isn't here, they put up the same chart down here. I'm going to go down to that. And I talked about the breadth thing. Now, what that, two things that whoever this commentator was neglected to mention, and I asked about it, did he mention this in the article? So when I put up this chart, here's the NYAD, which first of all, I don't put a heavy weighting in the NYSE. It's full of a lot of non-U.S. companies, some other things that really, it's not indicative of The S&P 500, it's not, and most importantly, this has been the leading market. So what I did is I put the NYSE Advanced Declining Issues line, which is, you can see, there's October, and boom, new high. So a lot of people are talking on this. I've heard a lot of buzz on this out on the internet. However, what has been the leading index for years since the day this bull market started? In fact, the bull market began with the Nasdaq back in 2008. It bottomed before the S&P, and it has vastly outperformed the NYSE, the S&P 500, the Dow. This has been our leading index. Most of our high growth companies and most of what makes up the indexes are tech companies, both the S&P 500 and Nasdaq 100. So what I did is a side-by-side comparison of the NAAD, which is a Nasdaq advancing declining issues, and versus the NYAD, which a lot of people are harping on. And you can see that it's telling a completely different story, not even close, about halfway up. Again, given this was 5 days ago, I haven't updated it, but you can pull that up. Stockcharts.com is where I pulled this information. And so again, they're telling a completely different story, and just food for thought. Okay, and now to, big picture stuff doesn't really tell you, isn't actionable as far as active trading. It might certainly help with 401ks, longer term funds, whether you decide, whether you're of the mindset that, hey, this may be nothing more than a bear market rally, and if so, this is probably within percentage points of the last chance to get out early, just like that first kickback rally in early 2008 after the market peaked in 07. Same thing back in 2000. Whether it'll prove to be that or not, time will tell. Like I've talked a lot on the long-term outlook, talking about some mixed signals, a lot of long-term indicators firing sell signals, some others that have yet to do, came very close but didn't do so. Now let's focus on the 60-minute charts. They've been tough, been had a tough time, a lot of sell signals, a lot of things that played out. They started to play out with corrections, trend line breaks, divergences, things like that were confirmed, but for relatively minor corrections. But this is the trend line I'm watching now and have been about for the last week or so. There's the one I mentioned in the beginning of the video, comes off the December 27th lows, and you have a lot of reactions on that. So I have them both here. And they both come in together on QQQ. And I want to get to the futures in a second. So there's reaction 1, 2, 3, 4, 5. And this is what I'm talking about, the markets losing that upside momentum. And that's really the nature of a wedge pattern. That's also why what you extrapolate from these momentum indicators. That's what divergence is all about. It tells you a rally or an advance is losing its vigor or strength. And so you can see lately, although the market's been walking up, we're talking, less than 1% a day now. We're closing up basis points positive and a couple days negative. So it's really been mostly for the last week or so sideways market. So that's the trend line I'm watching on QQQ. We're testing it now. When I have two in close proximity, these two happen to come in together. But if I have two trend lines that I think are both valid, I'll always give the benefit of the doubt to the last of the two to break, whether I'm looking at a bullish or a bearish pattern. You want to give it the benefit of the doubt to the trend. So wait for that one to go. I'm going to show you on NQ in a second. Let's just look at SPY. SPY, I have a trio of trend lines. I know this looks like a Christmas tree with all these colors, but here's the one off the 24th lows. We're testing that right now. I am undoubtedly a lot of eyes are watching that one. But I also have a similar one that I just showed you on QQQ off the lows on the 27th. Maybe that comes into play. We have 1, 2, 3, 4, now 5 well, not a reaction yet. We're on it. So reaction would be either a pulse of break through it or another bounce off that level. And then if we clear all those out, you can see here I have a potential price channel right here with this divergence line. Something that I covered in the earlier videos is the fact that divergence lines can be extended. They're just showing you divergence on the indicators. They're not in a sense, it's a trend line, but this is a trend line to watch for sell signals. As long as you have the divergences intact. Here, let's jump over to the 60-minute chart. So I'll show you what I'm talking about. Okay, this is NQ. It looks like we now have, this is for the last several days or throughout this week, the trend line I've been focused on in the recent videos and posting on the site. And looks like that's cracked. But as I always say, There's a lot of indexes out there. You can track as many as you want. I want to see breakdowns on both the S&P 500 and the Nasdaq 100 to confirm a sell signal. So we have it right now on the Nasdaq. It's pretty impulsive. I'll have to zoom in for you. But before I do, this is again the trend line off the 27 lows. Should go back to right here. It's almost there. So that one almost tagged. That's the trend line I'm talking about. And on the futures, we have 1, 2, 3, 4, 5. We can count that. Those are in close proximity. 6. And look at this price compression. We're really just going nowhere. And so that's the one I'm watching right now. Looks like it's starting to crack as I'm doing the video. We'll see what ES is doing, and then I'll wrap this up. Back to the point I was making about divergences. So, for example, you have the divergence is starting to steepen, if you will. You had divergence right here. We had some divergence building, and you can see the slope of the divergence line starting to increase. However, the way that works is if we happen to pop up here, as long as this line, move that one out, as long as this divergence line stays intact, if I can drag it properly, we have, you can see, there's a little room for upside there. That's how it works. Now, if we take out the previous reaction highs, then this indicator goes above those, and so does the PPO down here. That's the RSI above. We don't have divergence. There's plenty of room on the PPO to extend that divergence. However, this rally, as we all know, is getting very long in the tooth. So you've heard me say it before, and I've been wrong for the last few weeks, but I would put very good odds this breakout sticks, especially once we get confirmation on ES, which I'll get to here in a second. Finally, on that, I wanted to mention again, there seems to be a lot of anguish from those that have shorted the market or giddiness for those that, have been long in the last few weeks. Here's what happened. This is it in a nutshell. The bulk of the rally came from the lows on the 24th, and I kept warning about that explosive bear market. That's what a nature of a bear market rally. It's explosive. It doesn't let the longs in, and it doesn't let the shorts that stay too late to the party out. So this is the 18th of January right here. Remember, we bought them on the 24th, so just a few weeks. That was about a 17% rally up to that point. Now, let me just mark where I'm doing this. So about 17% of the rally in the Nasdaq 100 came in just the first few weeks. Since that point, I did this line and put it here yesterday, I think, looking at about just under 4%. So from the peak on January 18th up until today, the market has gained another 4%. 17%, 4%. So, what I was saying back here, I continue to maintain, and it is all true. The risk reward is just not attractive for chasing longs. It doesn't matter if it's gone up. If you say the risk reward's not attractive, it doesn't mean that the market can't go up. It's just there's minimal upside, especially compared to the downside risk. And this has been a one-sided trade. So my expectation is we'll probably see the last several weeks of gains wiped out in just a few days once everyone piles onto the other side of the boat. So longs take profits. The shorts who've been stopped out finally decide to come back in. And that's what that'll look like. I know this is a messy chart. Let me show you a clean version of it real quick. Okay, there it is. This is without all the extra trend lines, measurement tools. That's what you're looking at. Again, I use that trend line off here. This ES hit it perfectly. QQQ came in close, but there it is. It's a pretty clean trend line, pretty clean bearish rising wedge. Much bigger divergences than we had in the past. Again, those played out for little pullbacks, not as much as I thought they would at the time, but that doesn't change anything in the technicals. This is just a larger pattern with larger divergence, a more well-defined trend line with more reactions, which helps to validate it, and more overbought conditions. So therefore, looking at, you can see down here, these are the target levels. Minimum target right now for the futures NQ, a likely swing target. And even if the market's going to new highs, can't rule out this. So I'd put it this way, and this is what I said in some of the recent videos I did for members. This right here, about 60, where's that line? Let me try to put a marker on it. 63, we'll call it 63.90, is my, let's say my maximum downside target for my most bullish scenario, which has a market going on to new highs. this would be my minimum target right here. So if you're a dip buyer, and I tell this to my members, regardless of where I think the market's going, what I think I do a good job of is identifying key levels that are likely to produce reactions. So I can tell you if you're a dip buyer and you believe this market's going to new highs and you believe the dips will continue to be bought up aggressively, there's your target. There's where I think it's an objective long. You can either put a stop below, go long there, or maybe take a partial position there. And if we continue on down here to the next target, same story. Now, if you're of the mindset that this may have likely been a bear market rally and you want to short here or you've been short, then you can continue to trail your stops down or leave your stops and leave that trade open for a potential runner trade. In other words, a grand slam, because my next downside targets, should this market fail to make new highs and undercut the lows on the 24th, it's a little bit over 20% downside on that's on the S&P 500. It might even be a little more than that on the Nasdaq. Okay, and to wrap it up here, there's the S&P 500 futures, ES, and you can see a similar wedge pattern again drawn off. You can see a perfect reaction there on the December 27th lows, next reaction low. So we have pretty, what I believe to be a pretty valid trend line, a lot of reactions to help validate it. But you can see there's a little downside left to go on ES to give that sell signal. So maybe the way this plays out, sometimes when I see a differential between the two, between the S&P and Nasdaq, I just showed you NQ breaking down. So maybe we go a little lower. ES hits this, has a little reaction. At the same time, Nasdaq or NQ, which is already below, comes down and comes in for a back test. So just things to watch. But once this goes, and if the NQ, which it probably be, is still below its trend line, then that's about as good a sell signal as I could imagine. But who knows? Maybe it'll be more of the same. You have to give this market credit. It's been had a voracious bid. But again, as that long-term chart I showed you in the beginning of the video showed, that it's typical bear market behavior. So while we can't say with certainty, because there's still some long-term trend indicators and trend lines and support levels that need to be taken out to say with the highest degree of conviction that we are in a new bear market, that only time will tell. But like I said, the point I was trying to make is you just cannot rule that out despite the vigor and how far this bounce has gone up to this point. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.